Welcome to the Forever Cash Life Real Estate Investing Podcast with your hosts, Jack and Michelle Bosch. Together, let's uncover the secrets to building true wealth through real estate and living a purpose-driven life.
I understand that most of the other guys out there, what they teach is to get a $5,000 property for $500, pay the $500, and then turn around, or pay the $800 or $1,000, then turn around, sell it for $5,000, and then with seller financing and get monthly payments. And while this works, even there, you have the possibility and the potential of running out of cash. Because if you get 20 deals under contract and each of them is $1,000 with closing costs or so, then you owe $20,000. And who would and I'm going to show with you right now a method that you can get those 20 deals under contract. You can get those 20 deals flipped, but without using a dollar of your own money. How does that look like? Would you rather like to spend 20 grand on really bottom end deals that are not very pretty anyway, and where there is actually a potential that you get stuck with those deals if you actually have to buy them, or that you have to sell them at a price point where you don't even make any more money? Or would you rather like to do these deals in a way that you can back out of a contract anytime for any reason, that you can sell them, and that you actually have $0 in the deals, and you will never, ever get stuck with any kind of deal? Who is in favor of this one, where you have to put out 20 grand for 20 deals? Who is in favor of the day where you get the same deals with the same profits, with the same everything, but without putting a deal into these deals? Give me a heck yes right now here if you're. Give me a heck yes if you want this one over here, right? Because obviously that's one. A is this one, B is this one. Who is in favor of B? Hopefully everyone is in favor of B. Thank you very much, Jason. So with that said, guys, here's how you do it. So we select our areas, we select our properties, right? Typically, these $5,000 or $10,000 properties are usually in either around smaller towns or in more rural areas, and they're overall not like they're not super huge. There might be one or two smaller properties here. There might be 1 or 2 acre properties, or 3 or 4 acre properties in more smaller towns or rural areas that just don't have that much value to them. Okay. So once you get them on a contract, yet they still have a market. They have a market that typically is the market of the mobile home owning minimum wage kind of retiree that doesn't have the ability to take, and that's no value judgment in there. There's, unfortunately, in the United States, about 30% of the United States falls into that category ultimately, or 20-30% falls into that category when they retire, that they have no savings, zero savings. They have no equity in the house. They were renters all their life. They live paycheck to paycheck, and now they need to retire. And they need to retire in the next few years, and they have absolutely nothing to fall back on. So what do they need to do? They can't make payments of $500 a month on a $30,000 or $40,000 property, because they're only making $1,200 a month in their jobs right now, right? Or $1,500 a month in their jobs. And yes, I'm not getting into politics, but if it goes through that minimum wages go up, good, bad, or it doesn't matter, and there's no value judgment here, it will obviously put that segment in a better position to be able to afford more. So for our land business, it's actually a good thing. I'm only talking about a land business. I'm not talking about the overall economy, right? So bottom line though is they have nothing to fall back on, and they have very little savings. So what they need is, even on a $5,000, $6,000, $7,000, $8,000, $9,000, $5,000 to $10,000 property, they will need seller financing on that. So here's what we do. They do have usually though a little bit cash. They can sell their motorcycle, they can sell a couple of things to get some cash together. So typically they have the ability to get about, let's say, $1,000 to get about $1,000 as a down payment in. And that is absolute key here in this method. Because what we're doing with this strategy is the following. So you target those areas, or if you don't target them, if you do what we do, is we target anything from $5,000 or $10,000 all the way to $200,000 or $300,000. They'll come to you automatically anyway, right? Because every county almost in the country has some pockets with those $5,000 to $10,000 properties. So you get this $5,000 to $10,000 property. Let's say it's worth $10,000. Seller doesn't want the typical case. Seller doesn't care. They don't want it. It's like this lot in a rural town, just like our very first lot that we flipped, right? It was an $8,000 property that the gentleman went through a divorce. He didn't want it anymore. He didn't care about it anymore. He just wanted to get rid of it. So he gave it to us for $400 plus a few $100 closing costs. We ended up paying about $700 all in for that thing. Now, why do we only pay $300 closing costs? Because we on those kind of deals, what you want to do is you want to do what's called self-close on them. So these are the only deals that we do not use title companies or title attorneys for to do the closing process. Now, again, in some states, you still want to check the prices of title companies, because one of our coaching students right now has just done a few deals in Florida where the title company only charged him $350 for the complete title work, including title insurance. Go figure. I've never heard a title company be that cheap, but they done it, right? So the title insurance only cost $100 and then $50 FedEx cost and $200 for the escrow fee. Go figure. So that's actually very, very competitive, even compared to doing self-closing. So with that said, though, typically though, going to a title company is going to cost you $1,000, $1,200, or in some areas even as much as $2,500 or more, depending on the price point, of course, right? So in this scenario, let's say that would kill the deal. If the property is worth $5,000, let's say you have it under contract for $700, and now you have to pay another $1,300 for it, then you're in it for $2,000. If you now sell it for $4,000 or $5,000, it doesn't make any sense, because then there's another closing cost on top of it, and you're making $1,500 in the middle. That's not worth your effort, right? It's not worth your time of the day to do that. So therefore, if you do self-closing, however, you can do a self-closing for about $150. Because what you essentially need to do is a title search. Now, the title search, you can do it yourself by going to the title records and to county records for owner after owner of these properties, right? For owner after owner in the past, and see what's recorded to them. Or much easier, you can pay about $70 to $120, let's say an average of, let's say, $100, to what's called an abstractor, which is a title research firm that specializes in doing title searches. So you pay them $100. A day or two later, they're usually pretty quick. Within 2-3 days later, you get back the title report, which tells you everything you need to know about that property. And if everything is nice and clean, meaning the seller, husband and wife, bought this property 30 years ago, they're still alive, and they're willing to sell to you. They bought it from somebody else that they bought it cash for, so there's no other mortgages in between. It's all pretty clear, and they are still alive to sign the deed over to you. Then it's a pretty slam bunk simple deal. All you need to do is basically draw up a deed, send them the deed, they sign the deed, perhaps a disclosure document or any kind of other statutory documents that the state might require, like a preliminary change of ownership or if an affidavit of property of ownership change, so that where you basically disclose what you paid for it and what kind of a sale it was. The assessor does need that, and then they give you the property. It's simple. It's very, very simple. Like our coaches have talked hundreds of students through this already. Our coaches all do that themselves. So if you're in our coaching program, make sure you reach out to our coaches, and then they can walk you through that. Now, if you find a tax lien on there, or if you find a lien on there, then you need to basically see what it takes to remove that lien, right? So if it's an actual tax lien, all you need to do is pay off the back taxes. So if it's a tax lien from the back tax lien, then all you need to do is, when purchasing, pay the back taxes, and that lien goes away. If it's an IRS lien, then you would actually need to petition the IRS to drop that lien. And typically on a $5,000 or $10,000 property, the IRS will easily do that. There's a form for that you can Google, and then you fill that out, you send it to the IRS, and then the IRS will look at it and they will issue a release of the lien to that property. It's all not rocket science. And again, our coaches have done that. Our coaches have done this process. So if you're in our coaching program, if you just joined our coaching program, Natalia, then you will be able to talk to your coaches about that, and they'll help you through that process, right? So in IRS lien, again, you need to petition the IRS to release that. Now, the IRS might not release it if this is a $500,000 property and it's a $100,000 IRS lien. They might not agree with that. They might not release it because basically when that property sells for $100,000, they want to be paid, and then you have to pay the IRS first. But on a $5,000 property, they usually don't worry about it, and they just reliably usually release that lien. Okay, so now typically though, $5,000, $7,000, $10,000 deals don't have many issues. They might have, the worst issue that might happen is that somebody passed away and it's more of a probate situation. But again, our coaches are specialists. They do probate deals all day long in some cases. Some of them even specialize on these more complicated deals and get them in. So let's assume this deal is very, very clean, right? Is that very, very clean? So what you do then, you send them a deed, they send you a deed back, they sign the deed, they send it back, and then you send them the money. As a matter of fact, we're helping one of our students to do this literally today.
The super cycle is coming because, again, number one, mining is cyclical. All right, so it's been more than 10 years, about 10 years that it's been down and out. So it's time. Number two, the world has never seen a crisis like we're seeing today. Number one, you've got governments all over the world, and forget about Canada, the United States. I mean, all over the world, they are completely broke, and they're trying to figure out how to keep the economies propped up. So to do that, they are printing unprecedented amounts of money. So what does that do? Well, that devalues, the currency, right? And then on top of that, you've got this pandemic that's happening, worldwide, which is causing all sorts of chaos and further economic downturn. And then you got riots and unrest, again, in various countries. All of these things are something that gold, precious metals really, really like. They like instability, and gold has been a form of wealth for generations, right? This is not something new, right? It's always been treated as money. So any hard asset, the real estate is similar, right? As the dollar devalues, these hard assets become really, really important, and that's why gold is entering into a super cycle. It's already been up, significantly this past last year, and it's expected to go much, much higher this year.
Okay. So it's the fact that the currencies devalue it, and gold essentially is a currency. Right? It has been kind of the oldest currency that we know of. Yes. If we don't want to go into cocoa beans in the Mayas, but even before that, even in the Roman Empire, it was gold coins and silver coins and things like that. So we had gold is an established currency that the market falls back to in order to account for unsecurities. And every time there's a big unsecurity, you see gold prices spike up. So, and the second thing I heard you say is that right now the governments are all broke and they're printing money like crazy, trying to prop up the economy, which therefore will eventually lead to some level of inflation and therefore devaluates the money that we have in our pockets, the dollar bills. But it doesn't devalue gold. On the contrary, gold, somebody I think has said that 1,000 years or 100 years ago, you could buy a car with 10 ounces of gold. And today you can buy a car with 10 ounces of gold, right? So basically the value of the gold has remained stable, but you have to spend $30,000 or whatever, $20,000 for an entry-level car. And you had to spend $2,000 back then, or whatever it was for a car, like whatever the 10 ounces of gold is worth. Yeah. So with that said, what is your strategy on there? Are you buying mines? Are you investing in mines? How can one of our listeners here say okay, that makes sense? Are you telling them to invest in gold? Are you telling them to what is your thinking process about how are you capitalizing on that prediction, let's say?
Well, that's a great question. Both, actually. It's always recommended that a certain part of a portfolio should be in hard assets, right? Of course, real estate and gold and silver. So we always recommend that 5-10%. Sort of the 10% has been always the mantra. But so you have to look at your own economic.
You're including real estate into hard assets too, right?
Yes. Oh,
Okay, very
absolutely.
important to know. So good.
Well. Look. Think about it this way. I'll give you two examples. If you go back to the 70s when gold was about $35, right? And if we took 1 ounce of gold in that metal, put it in a bag and buried it in our backyard, and we took $35 and put it in a plastic bag and bury it next to it, and today, fast forward in 2021, we dug it out, right? What is that piece of metal? What is that 1 ounce worth today? About $18.50. But what is that $35 worth today? What, a couple of cups of coffee at a Starbucks, right? I mean, look at the devaluation, but look at the value of gold. And to look at a real estate example, right? My dad in the 70s was an engineer making about $40,000 a year. And the first house we bought, back in the 70s here in Vancouver was about $40,000. Right. But today, the same engineer makes about $85,000. But you know what that same house is? Over $1 million. In fact, it's close to $1.5 million. So look at the so the hard assets, to have an investment in hard assets is very important. But you know what? The only thing is that gold isn't. It's more of an asset, not an investment, right? It's something that you to keep, to protect your wealth. If you want to have leverage, that's when you invest in companies like ours, companies like Blue Lagoon Resources, or other companies, similar, that have good management and with a proven track record and have good properties. And the reason that is because when these commodities, when they get into a super cycle, for every small incremental rise in gold price, the stock of that company, the underlying company, goes up multiples of times. So what happens is that's when you get your biggest bang, your biggest leverage. So to answer your questions, what do I recommend? I recommend that people do both, right? I think they should have some amount, in hard assets, and some amount, exposure in good junior mining companies that are about to hit the super cycle.
Yeah, so I think that's a nice distinction between real estate and gold. Gold is something, like Warren Buffett says, that just sits there and looks at you and doesn't do much, but it preserves your value. Like real estate, particularly income producing real estate, is something that requires management, but therefore it typically brings in cash flow in addition to appreciation.
Yes.
Right. So your company and what you're basically saying, like investing in a company like you run, is like investing in real estate, because it's an asset, because it owns the operations of running gold or so, and it also owns. It's also valued as a multiple because it spits out cash flow because of its profitability.
Yeah, so right now we're not spitting out cash flow. We are about to go. We are working towards getting to production, and we believe we'll be there later this year. But that's where the value is, right? The value is, like, today. For example, one of the research companies just came out with a report that they released last week. They believe that our company is about 50% undervalued. And so how does the value of our company increase? It's something similar to a land position, right? So if you buy a piece of land and it's you subdivide it, you get it rezoned, and you make it into smaller parcels, that increases the value of that land. Then if you put a building up onto that increases the value of that property. So similar in exploration. We have a mine that is very close to production. So, we're valued at X today. As we're trading, it's amazing. We're trading at around 50 cents a share right now. We have a market cap of about $50 million. But as we put that into production, the value, of course, increases. As the value of gold goes up, that increases even further. And then, of course, we have a very large land package around that mine, which hasn't been explored yet. So we're doing that. So as we do more exploration and prove up that we have more ounces there, that further increases the value. And by the way, you mentioned Warren Buffett. You're absolutely right. For years and years, he's always said, hey, listen, gold doesn't lay any eggs. It just sits there. It doesn't pay any dividends. But what's interesting is about 3 or 4 months ago, he actually, for the first time, invested in a major gold company.
Okay.
Because he's starting to feel that the dollar, he's losing faith in the dollar, basically, right?
Right. Very cool. So now, how does your company select areas that they like that they think are high valuation area? This is more like, let's transition a little bit more, just something more educational things for our land flippers that are perhaps asking themselves, like, well, where should I go? Because we have all kinds of land flipping clients in our customer base. Some of them flip the little $5,000 properties for $500, buy them for $500 and sell them for $5,000. Some of them go after the multi-million-dollar properties, and some of them are interested in in land development, joint ventures, finding land that perhaps other companies are interested in, so on and so forth. So over the entire breadth of our customer base, I think there's a lot of interest there in just learning more about just like, how does a mining company determine where to even go?
That's to do with the geology. So, we have technical people, right, who look at basically the geology of the area. And these are known mining districts. So, for example, you said Arizona has a lot of copper, right? Well, copper is about to become in play, because guess what? Yesterday I was watching the news, and GM was talking about by 2040 they want to be carbon neutral. So they're going to have all their cars are going to be electric. When an electric car requires more than 4 times more copper than a regular car, right? And that's just one piece of it. So imagine worldwide, all companies moving towards electrification. And then, of course, stimulus. Governments typically, in order to get people back to work, they love building infrastructure. Roads, bridges, buildings all require a tremendous amount of copper. So you know what? Copper is going to become very, very, and the prices of copper have been moving up steadily. In fact, they've gone up about 50% over the last year.
So I'm not looking for rapid growth. I'm not looking for properties that are prime real estate. I don't want that. That all equals competition to me. And that's when I go back to that meeting I had. I'll never forget. It was on Midway Road in Dallas. And when they said that there were 65,000 registered real estate agents and investors in Dallas. And so for me, I want to go after areas that fit my business model and fit the price point of the deals I want to do. And so that way I can project out how many deals I'm going to do, about what my marketing looks like, about what my avatar looks like, what my buying avatar looks like. I mean, I have so much assets for RV, mobile home, build your cabin here, ride your horse here, park your RV here, walk to the lake here, kind of listings. So when I say reverse engineer, I already know that in this certain economy, these are the people that's here. Okay. Jack does a module, says you are not the market. Okay. So maybe this is an extension of that. You are not the market. Okay. So when I take my business model and the properties that I'm going after, I'm making sure that my price points or the properties I want to sell are actually there. Does it have sales inventory? Okay. Does it have sales inventory? And so if you're watching this and you're like, I've never done anything like this, I've never been in real estate, I've never owned my own company. Well, guess what? Either have I. Okay. Like I said, I was a truck driver. My wife was a waitress. Okay. I never looked at spreadsheets before. To this day, thankfully, I have a virtual assistant that does my formulas for me. Okay. So, no, this big operation that might be coming to your brain right now, just cut the cord, dude. Just let the balloon fly away. Just imagine all these scary thoughts coming to you. They're like balloons with cords attached. Just cut the cord, let the balloon fly away. Okay. That is not what I do. That's not what I want you to do. That's not what I would encourage you to do. I do not want to make this super complicated. Okay. I want to do deals where I'm under market, where I'm selling my property for anywhere between 60 to 70 cents on the dollar of what it's worth, and I want to make 10 grand, 10, 15 grand. How can I do that? Okay. I'm going to look at the demographics of this area. I'm going to look at the economics of this area. I'm going to look at the highway structure of this area. And I'm going to make sure that it's not in the Gobi Desert. I'm going to make sure, is there sales inventory here? Is there buyers here? And how long does it usually take buyers to buy property here? Okay. Because if it takes somebody, 6 months to buy a property that's the same price as mine, I'm worried. I'm like, oh man, I need to lower my prices, And so now I know what to offer. So now I know what kind of properties I'm going to. So I'm focused on those quarter acres to like 2-acre properties that are a dime a dozen in these areas where the economy is like, it's just, it's like, meh, I'm not looking for like Detroit where just this is tanking, you know what I'm saying? And I'm definitely not looking for like Colorado Springs or Denver or Dallas where everything's just like shooting through the roof. I definitely don't want that. I just want meh. Right? I just want meh. That's all I want. I want consistency. So I understand that if I get deals under contract, my comps are going to be easier and faster for me, right? I'm looking for easy peasy. Like I said, guys, I am looking for easy peasy. And so some of the things that we're talking about here is exactly how to do that. Okay. So consistency, congruency, no red flags, right? If I would have done that county. Well, actually, I did do that county. I did not check off the red flags of the farms and the oil rigs. And number 3, the prices shooting through the roof. I did not check those 3 red flags off the list. If I would have done that, I'd have done a lot better in that county. And I would have decided this is a bad county. This does not fit my criteria. So some things that really, really, really hurt me is when people don't pay attention to the details because yeah, that was me too, but there's just no excuse. You know what I'm saying? There's just no excuse. If you're going after areas, you can't put a square into a round hole. You just can't do it. You just can't do it. If you're calling the county and you're saying, can I put a mobile home here? And they're saying, no, you're not going to be able to sell that property to people that want to put a mobile home. Okay. So I learned that lesson too. I'll never forget. I had this property. It was literally 2 streets in from the city line. And so in the city, I couldn't put a mobile home and I couldn't park an RV. Well, I didn't know that. And so I was still posting it. And that's why I couldn't sell it. And then eventually I sold it for actually 10 times what I had it on our contract for, which is really cool. But I just couldn't sell it to that marketing campaign that I was hoping for. Right. So when you're talking, I'm worried I don't have the experience. I'm worried I don't have the money. I'm worried I don't have the support. Well, guess what? The support is me and the Facebook group and the other Land Profit Generator family and the other investors there. There's over 16,000 people that are dying for somebody to ask the right question so that they can answer it, right? And like I said, no money. Okay, well, guess what? You can do a double close. You don't have to buy the properties with the contracts we're using. In fact, we encourage you not to. Okay, in fact, we encourage you not to. But if you're starting out, I've done properties as low as $150. $150. Okay. Right when I got started. And in fact, one of the properties on my whiteboard, I got for $150. I am selling that bad boy for about $10,000 to $11,000 on terms. Okay. Where I'm going to take $1,000 deposit and $200 a month and let it ride off into the sunset. Okay. It doesn't have to be super complicated. So, what is my passion for land flipping, right? What is my passion for land flipping? And why did I actually reach out to Jack? I mean, this is a pretty cool story. So when I started doing this, I felt so empowered that, oh my God, this is my way out of the rat race. Oh my God, this is going to work. This is awesome. I really felt like my business, my land flipping career was going to empower other families to do the same. Right. So like once they got a property and they could build a house or they could put their trailer there or whatever, they're going to feel like leverage in life. They're going to feel like, man, this helped. And then maybe they're going to start. And so I felt like land flipping was just like this really cool way of empowering other people to get out of the rat race, just like myself.
I know most of your audience is interested in land and not single family houses. So I just want to go ahead and say up front, whether you need money for land or you need money for houses or you need money for apartments, it's all the same private money. We just structure a little bit differently. So anyway, I knew I wanted to get into single family houses. So From 2003 to 2009, the first 6 years that Carol Joy and I were doing this business, I relied on the local banks and mortgage companies to fund our deals. Hey, Jack, I was so naive. I never heard of creative financing or seller financing or subject to the existing note or wholesaling or any of that stuff my first 6 years. So again, I had relationships with local banks. So in January 2009, Jack, I called up my banker, and I had called him up many, many times for 6 years. I had 2 deals under contract to purchase, and I found out like that I had lost my lines of credit. They'd been shut down and closed, and I didn't know anything about it. And so I hung up the phone from my banker, and I thought to myself, what in the world am I going to do? I mean, back then in 2009, when I put earnest money down, I couldn't get my earnest money back. And so I called up my friend Jeff, real estate investor, was living in Greensboro, North Carolina at the time. I told Jeff what had happened. I said, what are we going to do? He said, well, there's this thing called private money. I never heard of private money, but I learned about it very, very fast. And so I put my private money program together. So here's the first distinction, folks. Private money is you're not going to a lender that's loaning you money out of any kind of institutional money. You put your teacher hat on and do what I did. I started teaching people what private money is, particularly people that have retirement funds. I taught them about self-directed IRAs, and I was able to raise over $2 million in less than 90 days for my real estate deals. So here's the first writer downer. And the first writer downer is it's impossible for you to fail until you quit. and so quitting was not an option for me. And I tell you, I learned about private money. I tell you, Jack, private money has had more of an impact on our real estate investing business than any other strategy or thing I've learned about private money. And so, when you learn how to do it, the money just starts chasing you, because I learned the hard way, when you chase money, it's like the money eludes you. Best time to get private money is when you don't need it, to tell you the truth.
That is right. That is right. Yes. We have people contacting us weekly. It's like, hey, I want to invest with you guys. Because we also buy apartment complexes, right? So we have this list of 500 people that want to invest with us. Yet at the same time, we currently don't have a deal for them. So they're like, hey, when is the next deal coming up? So when you don't need the private money, that's when you line it up, so that when you need it, you have it. So that's an appeal right there. If you're listening to this and you're currently doing land deals or house deals, then you're doing wholesales and you're doing assignments and you're doing double closings and things like that, still consider lining up money right now. Start talking. What you really enjoy, what I really loved you saying right now, Jay, is that you just flew over it. You barely even talked about it. You says you developed your education program about it.
Yes.
Now here's the thing. When somebody hears it, they say oh, you went straight into teaching how to do that and selling courses or something like that. No. What you mean to say is, the best way to raise money is by educating the people about how it actually works, so that they can make a decision of oh, wow, I want to do that, right? So did I hear that right?
Exactly, because in this way of getting funding, we make the rules. So when I was borrowing money from the banks or institutional lenders, and by the way, this has got nothing to do with hard money. This private money we're talking about, another name for it is relationship money. All right. So we make the rules. We set the interest rate we're going to pay. Or if you want to partner on a deal, you decide how much of that deal that you want to give up. Typically, I don't partner on deals. I just pay a straight 8% right now. But you decide on, in fact, in my new book that just came out, I'm going to let your viewers get a free copy of it here at the end of the show. But my new book, Where to Get the Money Now, lays out step by step the different parameters of your program that you need to decide. So, what's the interest rate? How often are you going to pay? In fact, you can structure deals to where you don't even make any payments. You don't pay the private lender any money until you have cashed out on your deal or your piece of land, And then at that time, you pay them what your program pays that you decided to. There's a presentation that I present sometimes. In fact, I'm presenting it later this week. The name of the presentation is How to Raise Money for Your Real Estate Deals Without Asking for Money. And so the reason I have that presentation is that I tell people all the time. So right now I've got about between $7.5 and $8 million that we're just rotating from properties to properties to properties. And people will ask me, Jack, they say, Jay, how did you raise all that money without ever asking for money? And I've already given the answer. I put on my teacher hat and I educate people on what private money is and what self-directed IRAs are. Now that's an actionable item right there, folks.
Right.
You see, me and Carol Joy, we've got 45 private lenders, individuals. These are human beings like us. We got 45 private lenders that are investing with us, loaning their money to us on our deals. Over half of them, Jack, over half of them are loaning us money from their retirement accounts. And listen, unless I knew about self-directed IRAs and unless I had a relationship with a self-directed IRA company to introduce these new private lenders to, because they never heard of private money till I taught them. They never heard of self-directed IRAs where they can earn tax-deferred income or tax-free, depending on the type of retirement account, until I told them about it. Well, if I didn't have a relationship with a self-directed IRA company to introduce my people to, I'd be missing out on over half the money.
Right. So let me dive into that for a little bit. I really love, again, I want to dive into that concept. What most people do wrong is if they first of all, they start asking for private money when they have a deal and they need it within the next like 10 days, right? That's the wrong way to do it. Now, can you find private money that way? Yes, but you're giving the other party all the leverage in that moment. Because there's like, yeah, you want my money? Here's the terms. Well, these are steep terms. Well, do you want to do the deal or not? Right? Are you going to lose out on the deal or are you going to do the deal? Right? No, if you have people lined up already that are saying like, hey, you know what, Jay, you know what, Steve, you know what, Christina, you know what, Susan, if you ever need money, let me know. What you do is really cool. And I would love to be part of that. Now you got them ready for you, and then you just keep them informed and keep them ready. And then when you have that deal where you need the money, it's like, you know what, I got one. This is exactly what I was talking about. Are you ready? And then they might still say no at that moment, but now if you have 10 lined up, 7 will say yes.
Well, you bring up a good point there, Jack. So I learned this the hard way. In fact, most of my most important lessons I learned the hard way. So learn.
So do I.
Learn from my mistakes. So
until I realized that the faster way to learn is through a coach.
You got that right. I mean, it's like, hey, look, you're going to pay for your education one way or the other.
That's right.
It's going to cost you a whole lot more in the school of hard knocks, and it's going to take a whole lot longer to learn it as well.
Absolutely.
So get you a coach like Jack and fast pace it.